Tesla announced in their 10K on February 8th that they bought 1.5 billion worth of Bitcoin. It's a big news story. I want to talk about Bitcoin as an economic concept and then how we think about Tesla getting into this space. This is the Not Even Wrong podcast. It's February 8th, 2021. This is Krim Delco. For the day, the fund is up 3.4%. The market is up roughly 70 basis points. We are up 27.1%. The market is up 4.2%. We're outperforming by 22.9%. Now, maybe we should start counting the performance of the fund in Bitcoin at this point, but that's another conversation. Let's just jump right into it. So first of all, the economic concept of Bitcoin is that you have a limited amount of money supply. So you have a currency which is actually fixed. So you have a fixed currency, and then the economy functions with a fixed currency. There's 21 million Bitcoin out there, and that is fixed. If you don't have dollars or reais or pesos or anything like that in the economy, then Bitcoin itself will just be Bitcoin and measured against nothing but Bitcoin. So let's assume there is nothing else. So we can't talk about how many dollars is Bitcoin or how many pesos. Maybe we can say how many ounces of gold can I buy with Bitcoin, etc. But overall, what you're going to have in a situation where there's fixed money is that people will start to compete for their relative share of the pie. And that's the key. So I think all the proponents of fixed money, the Austrian School of Economics and the gold bugs and whatnot, that's really what at least the intellectually honest people, they are after a system like that, because fundamentally what they say is, look, the competition in the economy for parts of wealth is not going to be driven by any kind of money supply or anything like that. It is simply the relative performance of your products and services, the relative performance of your work. So this is, also very Marxist in a way. It's your labor, your actual contribution to the economy, your products and services that in the end lead towards you getting a relative higher share of the economy than, let's say, somebody else. So fundamentally, this is what people are saying. Also, the Chicago School of Economics is propagating this view that the actual performance in the economy is not going to be driven by any kind of money supply, any kind of interest rate policy by the Fed, and none of that stuff. It is really just you have a fixed pie, which is, let's say, 21 million Bitcoin, and then there is people out there competing for parts of it. And the reason Bitcoin actually exists in the first place, or we need that kind of money, is that we can facilitate transaction. The function of money is to facilitate transaction. It's not even to store value, because you don't really need a store of value. In a fully barter economy, think about it, you would go get products and services by delivering products and services. And if you happen to have some sort of surplus of products and services, you would then go to a business and say, listen, I'll give you some of my products and services for future cash flows. And again, of course, that is in a diversified economy like we have today, very difficult to do without money. That's why we have money. So money is really just a transactional service. And what Bitcoin is potentially offering here is, first and foremost, a fixed money supply, so we don't have to deal with fiat money. And second, it is much more transparent and much faster and cheaper, and you don't have all these fees that are attached to it. So compare this to the Pony Express versus Telegraph or something. It's along those lines. So it's a lot more efficient, much faster. So that's kind of the economic thesis here. And again, what anybody, let's say the Chicago School of Economics would say, and that's, I'm been biased by that, going to that university, is that, listen, if you print money or don't print money, it's the same outcome. It is still the relatively stronger people who win and the relatively weaker people who lose. There's no benefit in having a Fed and all of that stuff. Here's the thing now. Let's assume that is correct. The Keynesian argument that you can have some sort of supply side response to money and all that, to the economy, is a fallacy, because any kind of government influenced intervention in the economy just deters the actual economic forces. It is unnatural, it is not organic, and therefore doesn't work. And we agree, actually, Orange Capital Partners, with all of these things. We're very orthodox, University of Chicago, Austrian School of Economics types thinkers. Here's the fundamental argument that the Bitcoiners make, that Goldbugs make, that anybody's making. That in the current system, there is one thing which is different, and that is that some people have the power to decide who's winning or losing in the economy by channeling money from A to B. Or in other words, printing money by the Fed actually benefits certain people. It benefits Wall Street, it benefits companies like BlackRock, MSCI, companies like that take advantage of money printing, and that is a bad thing. So since we don't have any kind of real economic benefit from the whole monetary system that we have, but we have a system that still benefits people versus other people, let's get rid of that. And this is so it's the power struggle that is really at top of all the Bitcoin conversations. Bitcoin is this hope by Silicon Valley to undermine the Fed's power, because since 2008, the Fed has gone overboard with choosing winners and losers, with saving banks and etc. in the name of the economy. And to some extent, that's right. But they also saved the banks themselves and the people. And that is something Silicon Valley is trying to undermine with Bitcoin. And now, with the growing acceptance with Bitcoin, this is possible. So in this context, we see Tesla's involvement in Bitcoin as another try by Elon Musk to free himself from the shackles of centralized government, of Washington, D.C., of this monetary system where the Fed is the top and the Treasury is kind of very close. Try to bring a new counterbalancing power to the economy, to the world, to the ability to execute freely in a transactional economy with free choice, with free uncoerced contribution of labor, etc., with something we call market economy. So within that context, I think this is coming. I don't have more details. The 10K of Tesla is not talking about any of that stuff. So now we want to talk a little bit about other points that Tesla could be having in the back of their minds, i.e. Elon Musk and the board. And the most important one is, of course, the energy question. If you have Bitcoin as a currency, you will still have a lot of requirements for energy, not just for mining, but also for transactional purposes. So basically, a Bitcoin-driven economy will have a lot of demands on energy. And Tesla, being a large energy company and a large non-fossil fuel energy company, this could be also used as a catalyst for the energy business. It has not been stated like that in the 10K, so I don't want to jump the gun. I'm just giving a certain, these are thoughts that we're sharing here, nothing more than that. There is a couple of other things, in particular payments themselves. You could argue that that is a smaller piece of the pie, because payments, as far as we know and as far as we're concerned as investors and participants in the economy, are not an issue, at least not in the US and in Europe, in a sense that the fees we're paying, they're not small, but they're not prohibitive compared to, let's say, what we're paying for education or housing. The fees that we're paying for payments, or even the taxes that we're paying to governments, they're relatively small. So nevertheless, there is obviously potential for innovation having a different payment system. So buying the car with Bitcoin is easier than buying the car with a credit card or with a bank. It is easier. It involves less work. Paying for charging, paying for apps, those are the kinds of things where we could see potential improvements in the future. The real holy grail, though, is the idea of crypto as a contract for machine-to-machine communication, for machine-to-machine negotiation. So Tesla, let's say, negotiating a parking spot, for example, in a machine-machine auction, Tesla negotiating a slot on a highway in the future that is driven by, of course, all self-driving cars. And in order to avoid traffic jams, you have some auction process where Bitcoin or a cryptocurrency is used as a part of the contract that actually gets executed in allowing access to the slot. So in those terms, of course, That's interesting. I don't think Tesla's in that business. I would be surprised if they have people dedicated to this kind of stuff, but it's something that maybe long term, the ex-founder of X.com and partly owner of PayPal, i.e. Elon Musk, probably might be thinking about. We should give the guy some credit. He has been in the payment business, in the digital payment business, way before Square, way before PayPal, way before, well, PayPal, okay, PayPal, the original PayPal, but not the current PayPal, and then way before any of the other stuff that we're talking about today, Venmo and all that stuff. So my point here is that maybe there is some vision here going forward in terms of contracts and negotiating electronic contracts with micropayments as part of the contract, and that's where crypto could also play a part, which is, by the way, I would say, in my view, the most interesting part of the cryptocurrency space. Now, let's get back to the crypto as a whole. We think that it is definitely an interesting concept, and we believe that crypto is a possibility to undermine it, or at least bring a check and balance to the current fiat money system that we have, particularly in the US and Europe, because the fiat money system is out of control in the US and in Europe. This puts the question, where does this leave us as investors? Should we buy Bitcoin? Should we buy Ethereum? Should we hedge ourselves? How should we play this? And here's the thing. Number one, our thesis has always been that we're better off buying productive assets than an asset like Bitcoin, which is not productive in itself. So we're buying Tesla shares, we're buying genomics, cell therapy, and I've spoken about our portfolio many times. So we have a productive investment. We actually have leverage. So we have invested more capital than we actually have in equity and cash. So we're short cash. So we're short dollars in that sense, and we're okay with that. Now, should we also add Bitcoin to the equation? The answer is no. We're not doing that for the following reasons. First, again, it is a simple equation, but we believe that productive assets are better than store of value assets. In fact, if you push it to the extreme, there is no such thing as store of value. Everything is about transactions, and everything is barter. The only reason we don't have barter is because we found a more efficient way to barter. We call that money. And we have dollars, and now we have Bitcoin. And no matter what, it is not productive to invest in those types of assets because they themselves don't produce anything. They're just facilitators. So if we have a view on wealth generation through fundamentally new concepts and engineering practices with large impact, then we should put our capital in those types of assets. If we don't, then it's fine. We can buy a store of value. That's fine. But since we do, and this is our job, and we would be doing ourselves a disservice if we invested in something like Bitcoin, then we can't. This would almost be, it would be an oxymoron. Now, on our website, we do say that we're an opportunistic hedge fund investing in commodities, currencies, equities. So therefore, there are times when we do invest, let's say, in currencies. We have invested in things like we shorted the real, we shorted the euro. So we do have views on these things. Not recently, and I think it is part of our strategy not to engage in those relative value macro trades anymore. We could come back to that point, and I think this is a very crucial point right now, where Silicon Valley technology, wealth generation, fundamentally new concepts, new engineering practices, and macro are actually at the crossroads here. So this is a very important point in the history also of our fund, where we have to think very hard if this is potentially an asset that maybe at first sight doesn't look like an asset we want to invest in, but maybe at a second or third it is. And to some extent, I am relieved that Tesla has done this for us. They started investing in Bitcoin. If Tesla can bitcoinize itself, then we as investors in Tesla, which is our largest position, have at least a certain hedge relative to Bitcoin growing in value. Because here's the thing. If Bitcoin becomes the global value on Earth, the global store of value on Earth, then people who own Bitcoin now will have a relatively higher share as a percentage of the global economy. So they will be richer than others. And it is our job as hedge fund managers, Orange Capital Partners, to make sure that we and our investors at least keep, if not grow, their percentage of the pie. This is what wealth generation actually means. Grow or maintain your percentage of the pie. If that pie now gets defined by Bitcoin versus dollar, we have to be conscious that some people, maybe somewhere in Romania, buying Bitcoin right now, will grow their pie larger than us, even though their investments are nothing other than buying Bitcoin. This is a problem. This is a problem in a sense that we could be undermining our own mission to generate wealth by maybe doing all the things right, really helping decarbonize the economy, helping grow, let's say, the electric car business, which we think is a great thing. It's also a wealth-generating thing. But at still, we could be losing relative percentage value of the pie because the pie is being redefined from US dollar to Bitcoin. So in a sense, it's a little bit like if you're a citizen of Argentina and you build a business in Buenos Aires and you actually have maybe contributed as a real economic player, done good things, but you have lost relative value to the rest of the world because your currency has been completely depreciated. Or Lebanon. My wife's from Lebanon, so I know what I'm talking about. That is a risk we have to be conscious about. Tesla is mitigating some of that risk because it's conceivable that if Bitcoin becomes the global currency on Earth, and Tesla is the first large S&P 500 company bitcoinizing, then the share of Tesla shares relative to the pie will grow extremely exponentially. Therefore, our share as Tesla shareholders will grow even more, if not at least at the pace of Bitcoin. Or in other words, we have a hedge here. So to summarize, Bitcoin is at the crossroads of what we do as Orange Capital Partners, which is generating wealth by investing in fundamentally new concepts and engineering practices with large impact, and macro investing, which is the art of finding relative value between stores of value and commodities and things like that. In the end, all our investment practices are geared towards the goal of maintaining or increasing our share of the pie being the global amount of money available to people. And if Bitcoin becomes the store of value for the future, then our share of the pie runs at risk of going down just simply because we are not exposed to it. However, since our largest position is Tesla, and Tesla is on the verge of bitcoinizing as the largest S&P 500 company, there is a chance that through Tesla, we are actually hedged, and investments in that company give us not just the growth and value generation through the company, but also the potential that if the economy gets bitcoinized, that the Tesla shares measured in dollars will appreciate enough to at least offset the impact of us not having actual Bitcoins in the portfolio. In other words, we have a hedge here against the Bitcoinization of the economy, and we still have the wealth generation potential that Tesla brings with it. Thank you.